So, I think to properly understand the infinite banking concept, it requires an understanding of what's wrong with the current monetary system. And, I think there's no better time to see firsthand what's wrong with the current system than right now with everything going on. So, can you explain in your own opinion what's wrong with the current monetary system? Let's start there.
Well, Costa. I'm glad that we're recording this for the next 5 hours because there's so much that I could go into. But I'll kind of give it a summary. The problem is state interference with the market. The problem is state interference with currency. If you look back on the history of exchange and the history of voluntary consensual economics, people used to go back and forth with each other without the interference of a government or state that's been now deemed necessary in our world. And I disagree that the government is a necessary thing, that central banks are necessary in our economy, because, as F.A. Hayek said in The Road to Serfdom, central planning by itself is completely fallible. I posted something this morning that talked about this. Um, if the Bank of Canada governor or committee makes a decision about the economy and is wrong about that decision, who pays the price?
Us.
You do. Yeah, we do. If they get it right, who pays the price? We do. And well, what do you mean, Mike? What do you mean by getting it right? The mandate for the government, mandate for the Bank of Canada, is to grow the economy at a 2% inflation rate. But what that really means is that they can't produce anything. The government and the Bank of Canada doesn't produce anything other than debt and the ability for banks to lend money, right, off the assets of the central bank at the time as the backstop to the financial institutions. So when we think about, well, why is this mandate of 2% inflation in place? Because they don't produce anything, all they're doing is producing demand, or pulling back demand for consumers to go purchase the goods that are in the economy. The issue is that the only two tools really that they have is manipulating interest rates and therefore the money supply. So what it really produces is a 2% devaluation of our purchasing power. So inflation, and there's so much going on in the regular media right now about inflation. The Bank of Canada's decisions to purchase government bonds, because the government can't, in a closed market auction, the government isn't selling their bonds in the open market. They're not. There's no investors that are lining up in March, April, May, June, July of 2020, lining up to buy a 0.75 5-year, 10-year Government of Canada bond. So who does? The Bank of Canada.
Yeah.
How does the Bank of Canada purchase these bonds? Well, it's an electronic transaction created with newly created money that is using these. So the inflation is really an inflation of money supply, which leads to a rise in prices. And I think most Canadians don't realize that the rise in prices isn't because those things are more valuable. It's because money is less valuable. I'll give you an example. The money supply since March 2020 in Canada increased by 27%. Over that same period of time, the economy grew by 2.7% on net, which means 10 times the money went into the economy as did the economy grew. So where does that extra money go? That goes into investing. That goes into real estate. That people take this extra money that they have, so to speak, and they deploy it in non-consumer spending. What happens? The values are distorted. The value
Yeah.
of a house isn't necessarily like, I look at the average house price here in Vancouver. It's like 1.6, $1.7 million for a regular. Well, you need, number one, who's buying them? Number two, and that's not necessarily, the statistics don't back up the fact that this is all foreign buyers. Foreign buyers account for less than 5% of the overall market in Vancouver. So it can't be them,
Yeah.
right? But when you take a look at the house price, the stock market, and now as it relates to commodity prices, they have all gone massively. The price of them has increased. But again, it's because there's 10 times the amount of money flowing through the system.
Yeah. You're seeing a lot of government solutions, for those listening, air quote solutions, but to inflation by essentially distributing more free money into the system, like subsidies and checks, and like helping people through inflation. But isn't that kind of just adding to the problem?
You're exactly right. The issue, if you look back in history, Weimar Republic Germany had the same exact same issues. And what they did is they were printing so much capital, or currency rather, that they were trying to fight inflation with the very thing that inflation was
Yeah.
being produced by, which is increased money supply. Now, Ludwig von Mises, who in my opinion is probably one of the greatest economists that has ever been and it will ever be, said that most people confuse the definition of inflation with the result of inflation. We call inflation rising prices, but in actuality is not rising prices. Rising prices is the result of inflation, which is always comes back to the increase in the money supply. Now, a little confirmation here. A lot of people would suggest that it's government spending is the problem. And while that's true to a limited degree, if you and I took $100,000 or $1 million and bought a government bond using the existing money that we had in our bank account, well, that's not inflationary. That doesn't drive inflation because it's not driving up the supply of money. That
Yeah.
is taking existing money and reallocating it. Is the real issue is the Bank of Canada printing, creating, again, for those listening, the air quotes here, printing. They're just keyboard entering money. They're not actually, there's no printing press.
Yeah.
This is all electronic.
Yeah.
The other thing, part of problem with inflation, that's, in my opinion, borderline collusion with the Bank of Canada, is the fractional reserve lending system in the banking system. So if I look back to historically, again, if I look back to the Medicis, who operated a lending table in Florence, that's loan banking, right? The same thing as me taking existing capital and lending it to the government. Well, I could lend it to, for example, if you had $100,000, you could lend it to me. We would agree on the interest rate based on the intermediary, the Medicis at that time, and today the banks. You put money into a 5-year GIC or term deposit, they lend that money out, and that's how they create the return that they're creating, the interest
Mhm.
rate. However, if you had money in your checking account, by legislation and law, they could lend out 90% of that value because they know you're not coming back for it
Yeah.
all at one time. So the sum of this multiplication is that we have a money and credit system that increases based on how much bank deposits are being lent out.
Yeah.
Um, just it's if you go to any bank financial statement, any annual report of any financial institution, you will see that if you match up their time deposits, which is term deposits and GICs, and match it up with their loans, there is a significant amount more loans in on their bank balance sheet compared to the time deposits they have. So inexorably, they're lending out savings accounts, checking accounts, and the RSP accounts that they have on balance. and this is how they multiply the money supply, or they've
Yeah.
been allowed to.
Yeah, at the core, it's a debt based system, right? And you know, how does this? So I don't think in any time in history this system has ever worked, right? So like, how does this come crashing down? Like, what's your thoughts? Like, what should people be? I think a lot of people are going to get very blindsided if they haven't been already with inflation. For those paying attention, obviously, you see this coming and hopefully position yourself in the right ways. But um, how do you see this ending? Like, this can't go on forever. Like, there has to be a breaking point at some point.
You're right. If I had a crystal ball to be able to tell you how I see this coming and was able to predict it correctly, we would be having this conversation. My background wouldn't be the wall here in my room. It would be the Cayman Islands or
Yeah, for real.
Bahamas. Anyway, uh, well, I think this is the fallacy of knowledge that I certainly don't know. And how could anyone know what's going to happen? And again, this comes back to how can a central planning institution such as the Bank of Canada try and make these decisions and get it right? It's guesswork. It's
Yeah.
merely guesswork. Now, there's a few probable conclusions to the way that this inflation will correct itself. We'll get this soft landing that Jerome Powell and Tip McClem have been talking about. But that's very unlikely, in my opinion. I think it's going to get worse before it gets better. I think we're going to see continued hikes in the interest rate, both in Canada and the US. I think we're going to fall right into recession based on the overindulgence or reliance on these interest rate hikes. Just because, in certain markets in Vancouver, secularly, and I'll use this as anecdotal evidence, the Fraser Valley area of Vancouver has come down maybe 15-20% in housing prices. The issue is that the affordability metrics, because the interest rates have doubled or even tripled, your mortgages are now more expensive. So your payments have gone up, even though the prices have come down. So everything is kind of equal.
Yeah.
So we're not getting a correction per se. We're just making it harder for people to afford homes. And so when you have local, municipal, provincial, and federal governments that are all trying to create these housing initiatives, it's counterintuitive to what the Bank of Canada is doing right now by making housing more expensive. So I don't think we're going to get a soft landing. Uh, are we going into a Weimar Republic hyperinflation where we're going to see maybe an acceleration, an exponential acceleration of inflation? It's an outlier. I'm not going to say that it's not possible, but it's very unlikely that solution is going to happen. And we're not going back. Guaranteed. The one thing I can guarantee you is that we're not going back to the way things were.
No.
We're
Yeah.
not going back to the kind of gas prices that we were used to, the kind of housing prices that we were used to. I will say this, though, is that everybody, because the narrative for inflation is surrounding around, okay, well, it's Putin, his actions against Ukraine, or it's supply chain issues. And while there will be some marginal effect of increased production is going to provide more things on the shelf. When you have more things on the shelf, the prices come down. But because we have more money on the shelf, there's a fundamental miscalculation in pricing, and now certainly, and has been since the advent of central banking, in my view. So there's lots of possibilities, only a few probabilities.
Yeah. Yeah, you're right. I wish you had the crystal ball, but I guess no one does. I was going to ask you about this as well. So for the average person that reads the news, goes on social media, they would think inflation is due to, like you said, supply chain, COVID, war in Ukraine. Like, there's very little mention in the mainstream news about monetary supply and how that affects inflation. So how much do you think that inflation is due to the money supply versus those other external um, issues that I mentioned?
It's incalculable. We don't know because we don't have a petri dish where we can have a control experiment to say insulatedly money supply was this factor without all the other supply chain issues and economic lockdowns around the world. So there's no such thing as a control experiment. So therefore, we can't really quantify. And because money supply, the real inflation, which is an increase in the money supply, which is a rise in prices or a devaluation of purchasing power, because it goes through the economy unequally, we can't say this percentage or that percentage was due to this. What we do know is that there's fundamental problems and exacerbating problems. The fundamental problem is money supply. The exacerbating problems is your supply and demand problems. Uh, Energy prices in Europe right now is a direct result of the supply of that's being pressured on by the Ukraine and other geopolitical factors in the Caucasus. But fundamentally, the value of the dollars that are purchasing that energy has also been affected. So there's no hard and fast rule. We just know that it's a factor, and much smarter minds than me might be able to put a number to it, but I would challenge them that they're probably wrong.
Yeah, for sure. Um, so how does then back to infinite banking? How does infinite banking mitigate your risk and exposure to this fiat monetary system?
Yeah, so this is a very hot topic in the infinite banking community. It's also a very hot topic in what kind of, I mean, generally speaking, what kind of assets are going to protect you from monetary policy. And so you have global economy to think about, the money system to think about, and alternative assets to think about. In his book, The Dying of Money, Ronald Merks, who wrote that book under the pseudonym Genzo Parsons, it's a heavy book, but it's very, very good. And if anybody wants to check it out on, I think Amazon's got it, but it's like paperback's like $50 or something like
What's it
that.
called? You said?
The Dying of Money
Okay, the
by
dying of money. Yeah.
Genzo Parsons. Yeah, it's a fantastic book. What in that book, to kind of summarize, if you don't want to spend the $50 and read it, I'll give you the Cliff Notes version. Uh, Inflation goes through the economy and affects different assets in different areas at different times. So, what we did see was the spike in the stock markets. And if you look globally, all stock markets took this similar dip. They all acted the same. They took this huge crash, and then within a week or two, it had spiked. And that was because right at the beginning of COVID, we had this massive stimulus package. Oh, the economy is dying and we need to save it. Again, coming back to the flawed John Maynard Keynes theory that government should print money to get us through a recession type of thing. So as assets are fluctuating, and certain hard investable assets are the first benefactors of increased monetary supply. So that was the real estate market and the stock market. From time to time, you need to have your money liquid in an environment where you can leverage against it in order to deploy your capital into different asset classes that at the beginning part of inflation start rising in prices or devaluing in purchasing power. What infinite banking allows you to do is very quickly and automatically have the liquidity available. Like you're going to create a pool of capital that's going to sit inside a properly designed, dividend paying, participating whole life insurance contract. And I'll get into why that's the asset class, that's a preferable asset class to replicate the function of banking. But by doing having that capital sit inside that contract, you have the first right of refusal because it's your money. So you can
Yeah.
borrow as much as 90, or depending on how you borrow, even up to 100% of that capital in order to deploy it.
Yeah.
Number two way that infinite banking protects you from inflation is the ability to pay off those loans at your discretion. In an inflationary environment, Costa, savers are punished, borrowers are rewarded. And the reason is, and we hear the argument that, well, government debt doesn't matter because they'll just inflate the dollar in order to, relatively speaking, shrink the debt. Well, that's a flawed argument because now you don't know what your dollar is worth. But regardless, everybody that had a mortgage of $100,000, well, what is $100,000 today compared to 5 years ago? It's almost inconsequential in relation. So if you had, for example, capital stored inside a properly designed contract, insurance contract, and you had $100,000 loan against the collateralized by that insurance contract. Now that $100,000, you've deployed it in an asset that's presumably appreciated, not because of anything that you've done specially as an investor or business owner, just by default, because everything's going up in an inflationary environment at the beginning part of an inflation.
Yeah.
So uh, the ability to borrow. The second thing is the ability for your deposits. Like, for example, if you have a premium that's going in to facilitate the payment of this insurance contract, well, the value is going down because the value is not appreciating. It's fixed. It's a fixed cost. In an inflationary environment, fixed costs are cheaper based on the reduced buying power. So, for example, if you're putting, as an example, $1,000 a month back in, well, let's just say in 1990, if you're putting $1,000 a month into an insurance contract, well, that's a lot of relative buying power for $1,000. Today, it's nothing. You know, you go to one of these restaurants down here, one of these new Michelin rated restaurants in Vancouver, you're going to spend $1,000 a plate. So, am I going to get the temporary enjoyment out of that money? And this comes back to the everybody makes an economic decision about how they spend their money. Well, do I enjoy the ability to have $1,000 king crab meal, or do I make my monthly contribution for my future?
Yeah.
So there's a whole lot of economics that are involved in that, but we're always making decisions. So the decision for clients and for myself certainly is that I decided to start setting aside my cash, and I turned it into a pool of capital over time. That pool of capital has been useful for me to leverage against for whatever reason I want.
Yeah. You you hear a couple questions that I want to unpack there. Some people look at the infinite like a whole life policy as an investment, and some think of it like just a hyper savings account. Like, how do you view it? Is it an investment to you?
No, absolutely not. It's the fountainhead from which all investments should derive, which
Yeah.
means I'm setting aside my money. I'm getting a better than bank rate return, but most importantly, the capital that's accumulating inside that insurance contract is a tax exempt vehicle to store my capital. And then when I want to invest, I'm not withdrawing that money out of that policy. I'm using it as collateral in
Yeah.
a loan situation.
Yeah.
Um, so therefore, the money's growing in two places at once. I got my savings, I got my investing.
Yeah. Got it.
Two separate things.
I agree. So another question I have: so these insurance companies issuing these policies, they're playing in the same system that we're talking about, right? So do you does it concern you at all that the assets that these insurance companies are deploying their capital in are not gonna perform the way they have due to this fiat system eventually? collapsing or going down? Like, I know we can look historically, and these policies have never like not paid a dividend, through Great Depressions, World Wars, and all that. But do you think there's a potential going concern for that not always being the case with these insurance
That's a
companies?
great question. There's a couple points that I want to make on that. Number one, because the insurance company pools of capital, these participating funds, are not speculating. They're doing the same thing that the banks are doing. They're just not doing it on a fractional system. So, for example,
Mm,
it's essentially a loan pool, and it's a loan pool where I could be the beneficiary of that loan pool. I could be the primary beneficiary of the returns, and because I am also a borrower from that pool of money, because remember, you're not borrowing against your money, you're borrowing against the total money that's in that pool. And the total money, I'm paying it back, and that indirectly, that interest rate that I'm using, that I'm paying, is indirectly going back into my contract
yeah,
because it's part of the return in the overall pool. Uh, that's important. Number two is, because it's loans, do loans exist? Does a contract, a collateral security agreement, not exist anymore because of the monetary unit that you're using to calculate the returns on? No. There are many different currencies in the world. If we go to central bank digital currencies, CBDCs, and if that's the kind of the direction, and I know that the U.S. Fed is kind of quote unquote testing this out right now, this whole idea of CBDCs, um, then the currency will all convert likely. Again, I don't have a crystal ball, but in my logical deduction, the value of the Canadian dollars that I've got, not invested, but saved inside my insurance contract, are going to convert into a CBDC if that's the case. It's still as a centralized currency, to your point about fiat. But if that collapses, remember that I'm probably leveraged already against those things into non fiat assets. So, what does that look like? I might purchase a storage rental facility, or participate in a storage rental facility, which is being paid again by fiat currency. But what if that's being paid in other ways? Maybe I'm into the crypto space with through leveraging my policy. Maybe I'm in the gold or silver space. Maybe I'm in the real estate space. Maybe I'm in some other investment. Like, what else could you do with the money that's in your account, or in your policy rather? Whatever I want.
yeah,
So therefore, don't just stay in fiat currency derivatives such as the stock market, mutual funds, or anything like that.
yeah,
If Because there is a percentage of the people out there that are all very concerned about the fragility, if you will, of the current monetary system, which has been in place since 1944, and more recently since 1971, when the gold standard was abandoned. Yeah, leverage against the contract if you're really worried about the collapse of a fiat dollar, and get into non-fiat based asset classes.
yeah. So a couple more questions with that. Like, is there? Would you say what happens to these policies in the event where borrowers that are leveraging against their policies not being able to pay back because their investments that they thought were good were involved in this collapse or whatnot? What happens in that case?
So there's a couple things that may happen, but I want to preface my comments here with, where's the risk? The risk isn't in the insurance company. It's not in the contract. The risk is in whatever investment that individual decides to do, right?
Yeah,
So in terms of, if that person can't pay it back, let's just say, cost that you've got $100,000 sitting inside in a cash value of your life insurance contract that you have diligently been disciplined to save over time. And the dividends that have been paid into that by the insurance company, the returns that they've experienced, have accumulated both with your contributions plus the returns on your contributions, minus the expenses of the contract. So let's just say you've got $100,000 in there now, and you borrow $50,000, and you're like, I bought FTX stock. God help all those that people out there that bought FTX, especially Ontario Teachers Pension Plan. Oh my gosh.
Yeah.
How'd you like to take a $91 million write down? Anyway, let's just say you invested $50,000 into FTX. So that's, for all intents and purposes, worth zero now. So you've got a $50,000 loan and you've got a $100,000 cash value. Well, imagine that's just like a mortgage, right? Does the $50,000 loan affect the growth of the 100,000? No, the full $100,000 is still appreciating. So you could do one of a couple things. Number one, you can continue to attack that loan at your discretion. If you've taken a policy loan, you could pay interest only. You cannot make any payments. You could pay that off at any time at your discretion if it's a policy loan. So you will continue to ride that loan. You've taken maybe some tax. You've got some other capital gains that you've taken in your life that you've written off with this capital loss of FTX. From a tax planning perspective, you've got maybe a huge tax return somehow. Throw that against the policy if you wish. Pay that down to zero, that policy loan. That 100,000 has never stopped compounding. Or you could pay the interest and continue to pay the interest as an investment expense. That investment expense, you're not accruing a greater value. You're keeping that loan at 50,000. The 100 is still growing. Or you could collapse the policy. I mean, I don't know why you would, but let's just say that you decided to do that and you walked away from the policy. So now your cash surrender value, you take the net of that cash surrender value and pay off the policy loan, walk away with whatever growth you've got on the 100,000 since the time that you executed the loan. If you died while that policy loan was outstanding, and let's just say you had $1 million death benefit, a $100,000 cash value, and a $50,000 policy loan, well, your beneficiaries would get a tax-free payout net of the policy loan. So $950,000 would go to your beneficiary.
Mm-hmm. Yeah. Another question I have. So, when you look into what these insurance companies invest in, very low risk assets, right? Like, real estate, bonds, corporate bonds, and all this. I read an article recently about San Francisco office vacancies. I think it was like 25%. These like big office towers are vacant at 25%. Does that concern? I know, and I know San Francisco is, kind of like the melting pot of like, money being thrown around and all this, but so that may not be a good example that can translate into other areas. But when you see that like 25% vacancy rate, knowing that insurance companies are invested in these office towers, what are your thoughts on that in general?
Mm-hmm.
Like
Yeah.
and even like COVID, and combine that with the fact that we've learned that more and more companies can operate effectively and more efficiently in a lot of cases being remote. So like the need for office spaces and what was once a great investment or great return might not be the best because there's not the same usage for office space. So yeah, just general thoughts on that.
Yeah. I love what Nelson Nash, who is the developer, originator of the infinite banking system, said about purchasing land. If you've got, for example, and I'm not just talking about commercial or industrial space, but if you've got a piece of property that's maybe 100 acres and it's timbered, how many different uses of that property could you have? You could harvest timber. You could develop the land. You could replant the timber that you've harvested and grow it over the long long term. What actuaries do is they see things over a very long term. San Francisco, having, for example, that 25% vacancy rate is a temporary thing. Will the economy correct itself so that that vacancy rate will come back to maybe 8.76% over the long term? Probably. But the actuaries, because it's not a money manager, in my view, money managers are looking for the returns in order to get those quarterly rankings in a mutual fund. Well, this is very, very different. The asset classes that the actuaries are going to invest in are going to be stable and very long-term sustainable. Whether that is they might purchase a bond in Microsoft. They're not going to purchase a bond in a startup company. They're going to look internationally. They're going to look through different asset classes. And one of the only place where you can get a very specific asset class is a life insurance contract, and that is what's called mortality credits. And mortality credits are based on people that are perhaps living longer. They've qualified for insurance because they're very, very healthy. They've increased their deposits over time, and so they're letting the insurance company off the hook for mathematical reasons that I won't bore you with the details today. But the longer a life insurance policy exists, the less risk that it poses to the insurance company, because the less death benefit is reliant on the insurance company. So therefore, these mortality credits, as people tend to, for example, live longer than the charts that they're currently using, which were just updated to, I believe, 1990 charts instead of 1950s charts on these actuary tables, people are living longer than they were in 1990. So all the death benefits are calculated based on the risk that they're going to have to pay out this very significant amount of death benefit at any time. And the numbers don't lie. Actuaries have managed these since the 1847 was the first whole life contract sold in Canada. They've done very well over this last 175 years. So it's a different outlook when you've owned assets for, for example, let's just say that the policy that was started first in Canada was 1847 by Canada Life, one of the first insurance companies in Canada. That insurance policy maybe purchased some assets, and that asset has been producing, presumably, a return for 175 years. They probably own that building. Mm-hmm. So what does that building need to produce? What is the vacancy rate where that building no longer makes sense to own? So 25% vacancy rate may or may not be a big deal for the life insurance company, because if they own 100% of it and don't have any debt, they're just streaming an income from it. Well, they need 25% occupancy. Yeah. Maybe not 25% vacancy for the numbers and the math to make work. So it's a very interesting asset class for sure. But what we know is that actuaries do take about 100-year view on assets and overall the returns of the pool.
Yeah, makes sense. Do you think those that are set up with high cash value whole life policies, the infinite banking concept, should be leveraging their cash amount into other assets? Like, should they be doing that?
In my opinion, yes. Now, what should they be doing? Well, I think I have this little snide comment that all certified financial planners, of which I have been one since 2006, we go to school or we take our education in order to learn how to say it depends. So I'm going to say it depends. Should you leverage? It depends on why you set it up in the first place. Maybe the sole reason for you to set up that policy was to distribute a tax-free amount of capital to your beneficiaries or a trust on your death. Maybe. Maybe you're planning on using it you set it up for your kids and is an alternative to an RESP. Kids typically don't go to school and then not continue to live, generally speaking. So they're going to need, why put your capital to use for 17 years when they're going to be alive for 87 years? You're missing 70 years of growth on that capital. So, in my view, because it's not an investment per se, it's a great way to store your capital in a tax exempt environment. But it's only, to our point earlier, it's only a holding tank for the things you plan to do with that. A great example would be realizing that if you were to take your 30, 40, $50,000 that you have in your account and use it to pay cash for a car, well, you're guaranteeing yourself a 20% decline in the value of your cash because of depreciation. Is that the best use of your capital? Or, rethinking your thinking, should you use your insurance contract as a banking system so that the use of that capital can still be used inside that policy, generating that return, but using it and leveraging against it for the use of purchasing a car? Maybe.
Yeah, good answer. I like that. I like it. Um, so, in my opinion, like everything we spoke about about the issues with the monetary system, fiat currencies, fractional reserve, banking system, to me, right now, one of the only solutions I can think of is like Bitcoin. For many reasons, which we don't have to
Yeah,
get into. But like, what are your thoughts on Bitcoin?
yeah, people should have it. To what
I
degree
agree.
they should invest in it? Uh, it depends. Coming back to my snide CFP answer, it
Yeah,
depends. Um, the issue is valuation, of course, and the issue of Bitcoin valuation is how much risk is one person willing to take in crypto, whether that's Ethereum, Bitcoin, or any of the altcoins that exist. Um, should people keep that on an exchange or in a wallet? That also depends. My personal preference is wallets, not exchanges, but depending on what kind of use you're going to have. What is the reason that you're holding on to Bitcoin? Are you purely speculating, or are you trying to get out and use an alternative system of currency? Again, it all comes down to, it depends. Should people be purchasing Bitcoin and leveraging against their policy? Again, that depends. It depends on your overall system of finance and economics in order for you to make sure that you're working with an authorized practitioner. And I think that's one of the big keys to infinite banking, Costa, is that people aren't, in Canada, typically they're setting up these policies because they're using an advisor that thinks they know what they're doing, but they're not using an authorized practitioner. There's about 45 across Canada. People don't necessarily need, I mean, I've got my bias. I think they should use one through the Infinite Banking Canada group, but I know many highly skilled, highly qualified infinite banking practitioners across the country that aren't participating in our group. But in my view, I think they should default to an authorized banking practitioner, not an investment advisor or an insurance agent that thinks they've heard about it and knows how to do it. They just simply do not and cannot set up the policies as correctly, and more importantly, help you how to use those policies correctly within the Income Tax Act. So
yeah, and I learned that too. Like going down this rabbit hole of infinite banking and speaking to actual infinite banking practitioners versus other very smart people in the industry, but not too familiar with this, and like the knowledge gap is definitely vast. So I would highly
yeah,
suggest anyone thinking about this to actually speak with a practitioner, like you said.
yeah,
Um, I have a couple of questions about infinite banking relating to businesses. So, a lot
mm,
of entrepreneurs use the infinite banking concept and these policies in their businesses as well. Um, can you talk about when a business should be thinking about implementing such a policy and what advantages a business would have by doing so?
yeah, absolutely. So this comes back to the Income Tax Act. It depends on whether a entrepreneur is incorporated or unincorporated, as a sole proprietor or partner, having a partnership, an unincorporated partnership. So the first level is understanding what kind of business is going to have the need for an insurance contract. There are many businesses out there who have business partners who have an agreement to purchase each other's shares of the business should the one of the partners pass away. Well, you can use the company money in order to pay for an insurance policy to pay out a death benefit. And I won't get into the tax benefits. There are many, many different tax benefits of that. There are other incorporated companies that are maybe a single shareholder or a family type business as an operating company who now have a problem with I need to sell my I want to sell my business. I want to do a share sale, and there's certain benefits to selling shares within the Income Tax Act that give rise to an over $900,000 capital gains exemption within the Act, but they have to purify those shares. So let's just say you've got an operating company with maybe $3 or $4 or $5 million in passive assets inside that operating company. Well, you're going to need to speak to a tax professional about how to purify. And there's many ways to do it. And I won't get into the many ways, but you can use trusts or other corporations or anything, holding companies where you can pass out and flush out the passive assets in order for the business to qualify for that capital gains exemption. There's very specific rules within the Act that you need to do that. However, if it's going to be a lot of my corporate clients are professional corporations. So these are doctors, dentists, lawyers, accountants, realtors, mortgage professionals, any professional that has an incorporation. They're not going to sell that company, and they're going to simply just wind up operations, and then they're going to have this lump sum of retained earnings that they've accumulated over the years. Well, it's very inefficient to have those retained earnings, those corporate retained earnings, sitting inside a bank account. Why? Tax. Most people don't realize that when their accountant says, here's how much money you made, here's how much tax you owe, well, everybody's thinking about their operating income, which has fairly decent tax rates. The British Columbia tax rates for operating income under 500,000, you're going to pay 11% in British Columbia. And if you make more than 500,000, you're going to pay 26% on any amount over the small business deduction rate of 500,000. However, if you have retained earnings, let's say you've got $1 million in your corporation that you've invested, the tax rate on the income or gains that are derived is 51%. In British Columbia, that's 50.7%. So give or take 51%. And so you've actually got potentially three different tax rates going on in your corporation. Well, remember that in an insurance company, an insurance policy, a bona fide insurance policy that's not designed for cash, but there has to be an insurable need for that insurance inside the corporation, and most often that's to pay out a death benefit for the shareholder for any number of reasons. Well, those tax exempt insurance, those bona fide insurance policies, have the ability to store corporate capital if it's owned and paid for by the corporation. What's the benefit of that? It's tax exempt. So instead of paying 51% on the earnings, the passive earnings, which is like interest, rents, royalties, anything that's not really active income, I now take that 51% down to zero, because now it's I can't really call it a tax shelter, but it is sheltered against that tax. So what do people do with that? Well, they still, because the money's sitting in the insurance contract, the business now has the ability to liquidate collateralize and control that amount of money inside the corporation for whatever that business purpose is. Potentially, depending on the reason for the use of that and the loan that's derived using the insurance policy as collateral, it could also give rise to an income tax deduction on the interest cost, right?
Mm-hmm.
So you're still paying the interest. It's still flowing into your indirectly into your insurance contract through the general returns. But now you've maybe potentially got an income tax deduction on the interest rate. So not only is it going to shelter more money from paying that passive rate of the punitive passive income tax rates, but now you're also potentially giving rise to income tax deductions. A lot of business owners cost to use the strategy. It's a very high level strategy called an immediate financing arrangement, and that's using an insurance policy and then essentially immediately borrowing against that policy to pay for expenses. If you do it correctly, it could work, and if you do it incorrectly, as most advisors set it up incorrectly, it could fall apart and cause massive bad tax consequences, and that's an actual technical term. It's massive bad. Uh, but I, in my view, I always have said that IBC, using IBC in a corporation, is the same thing as having a self-directed immediate financing arrangement. You're not bound to have to take the loan. You're just, again, just the same as a person who's allocating their savings into an insurance contract because it's the most efficient platform to do that. Now I have the business that has the ability to shelter that money. Now, a couple of pro quos on that. Even though it's tax exempt, and if I'm going to have an operating company that owns this policy, I still have to flush that out if I'm going to sell the shares of that company, because it's treated as a passive asset, even though you're not paying tax on that passive asset. The death benefit could credit the capital dividend account, which is a tax-free dividend. So when that shareholder or insured person on that insurance policy passes away, the company can flush out that money, which is maybe the entire death benefit, maybe not. Flush that out as a tax-free capital dividend. Furthermore, the shareholder, if it's a Canadian-controlled private corporation, can use that if they're the only shareholders. In my view, it's best when it's a holding company or a ceased operational company. The shareholders can use the collateral value of that corporate asset, but they can use it personally. So instead of withdrawing money, they can take out an insured retirement strategy where they don't have to break the corporate seal. They use, you said it earlier, that the economy is run on credit. Well, why not use credit as a leveraging tool against that corporate asset so that they're not paying a taxable dividend? I've worked with many accountants on that, and I've had accountants who, after have spoken with me, have decided to implement it in their own practice because it does work.
Yeah.
So,
Are there any ways to use a policy for in the event a business gets acquired, for example, or you know, allocating funds or in a policy to reduce like capital gains tax or anything like that? Any
yeah,
strategies like that?
yeah. So, for example, if I were to set an insurance contract up in my holding company, and instead of holding my passive assets inside my operating company, I transferred through an intercorporate dividend those passive assets up through to my holdco, and my insurance policy is in my holdco. Well, I'm sheltering the growth of that, or the interest that I'm usually earning in a bank account in my company name. It's now, I'm not paying that almost 51% tax. It's sheltered. It's tax exempt. But because I've flown up all these dividends over time into my holdco, I've kept my operating company pure. And in the Income Tax Act, we call that a qualified small business corporation, a QSBC, which means those corporations are eligible for the small business capital gains, lifetime capital gains exemption. So presumably, if I'm the only shareholder of a company and it's somewhere in the mid 900s, I don't know the exact number off the top of my head, but it's in the mid 900s that I get to have a capital gains exemption. So if I have an 800,000, if I sell my company for $800,000, I have no passive assets inside that operating company. I can presumably uh, not have pay any tax on that exemption. Now, I do have to watch out for those people who are listening who are like, but is it really all tax free? Yeah, it's all tax free. However, I still may get caught up in the alternative minimum tax AMT rules. So again, I'm not a CPA, but you need to be guided through that whole process with a qualified tax professional.
Yeah.
Uh, but the number one thing that I see, Costa, is people that are sick and tired of paying tax. They're looking for, and essentially the way that I view a tax exempt life insurance contract inside a corporation. It's a way to duplicate a TFSA because a corporation can't own a TFSA,
Mm.
but they
True.
can own
Yeah.
an insurance contract.
Yeah.
And I get that I don't lose the control of that money. I don't lose the liquidity of that money, and I still get to take it out personally without paying tax. And there's a lot of rules around that, but suffice to say that if you set it up correctly, it does give rise to that benefit.
Yeah. What if partners like split up? There's a policy and partners like split up, business gets dissolved, and not on like good terms. Like what happens in those scenarios?
Yeah, I think that that's a great point to bring up, and it's one of the reasons that it's not true that we never have a joint life policy. I'll give you the example of a husband and wife. They've maybe been successful. They've had a good run at depositing money over time into their insurance contract. Both names are on the contract, but now they're going through a divorce. Well, there's a split of that policy that needs to happen,
Hmm.
or at least consideration of that policy, that maybe one spouse gets a policy and the other has to buy that be bought out for that policy. Typically, in a corporate scenario, we see policies that are single name. We don't see a lot of corporately owned policies that have two names on it that are business partners. As a matter of
Mm.
fact, that's probably not recommended. So it'll be individual contracts. Let's just say the corporation dissolves. That company, the assets of that company have to be wound up somehow. So likely, what's going to happen in a proper tax plan is that the tax professional is, instead of taking that money and those assets personally, which I'm now going to have to pay tax on, they're probably going to go through a series of steps. Starts a holding company, a personal holding company for those two shareholders. The company gets split. Their insurance policies get split or canceled. If it's a term
Yeah.
insurance policy that's being used, it's fairly easy to cancel or transfer. There may be some rules on disposition of a policy if it's got cash in it. So all these rules have to be considered um, in the form of, okay, how do we do this? I see a lot of insurance policies in holding companies that still facilitate the share buyout in the operating company because there's an agreement that's signed between the business owners that the purpose of that insurance is to buy my shares out on my death. You Costa may or may not want to be in a business partnership. If we're business partners, you don't want to be in a business partnership with my spouse who may or may not bring any business acumen to the table that I might bring, or things of that nature. So first right of refusal on the shares, right?
Yeah. Makes
The
sense.
unfortunate part is that a lot of business owners have a handshake deal.
Yeah.
Who doesn't adhere to a handshake deal? The spouse of the deceased shareholder. Well,
Mm.
we had an agreement. Well, I don't care.
Yeah.
Where
It's true.
provide such an agreement? Just show me the evidence of this agreement. Well,
Yeah.
it was a handshake deal. Good luck with that in court.
Yeah. For sure. What about any like um Are there any ways to use this policy as like a tax deferral method? Like if have a capital gain that you cashed out on, whatever it was, and funneling that into a policy, is anything like that possible?
So the rules on a capital gain don't change because you have an insurance policy. The payment sequence, or the payment structure of the facility in order to pay that capital gains can be best paid through an insurance contract. I'll explain why. If you had a company that didn't qualify, maybe it's a holding company, you've got land assets, maybe you've got your Bitcoin holdings in a holding company or something for that of that nature, and you pass away, that company doesn't and would never qualify as a qualified small business corporation, and wouldn't qualify for different post-mortem planning such as pipeline planning or 164(6) planning. You would have a deemed disposition on those shares,
Hmm.
right? The disposition is taxable, but the insurance policy that's used on your death, that's paid out on your death, can be used to pay those taxes. So we can't avoid
Yeah.
paying for those capital gains, but we're just saying what's the best facility to pay for those capital gains taxes.
Do you see
Uh,
that often? People leveraging
oh,
their policies to pay their taxes? Is that advisable
well,
strategy?
they wouldn't leverage against them to pay their taxes. The death benefit would pay out in order to pay those taxes when they're due on a deemed disposition. You're deemed to
Right.
have
Yeah.
disposed of your assets on your death. So um, we don't have any estate tax in Canada and estate fees in Canada. We have some probate fees, province to province, depending. But we don't have what the US has, which is the IRS assesses fees, specific fees and costs to estates that are worth over a certain amount.
No,
We
so
don't.
let me rephrase it. Let's say
Sure.
someone, or paint like an example. Let's say someone, bought shares or like bought Bitcoin. Let's just say like 10 years ago, cashed it out today, and they have a huge capital gains, and so they owe a lot of taxes next year or whatever. Is it advisable, and you have a cash policy, is it advisable to leverage a loan from your cash policy to pay that your taxes next year?
Again, it depends on the structure of the policy, who owns the policy, who pays for the policy, how much cash value there is, and is there any other reason that you want to keep that? Let's just say, for example, that you've got Bitcoin worth $2 million. You bought it for $100, so essentially zero. You now have a $2 million gain based on the current rules. The inclusion rate is 50%, so you're only going to be assessed tax on $1 million that is going to be included as income. So now, in a 53% tax bracket, let's just say 50 for nice easy math, you've got $500,000 tax bill. So let's just say you have $1 million of cash inside your insurance contract. Well, if I had capital that I would use to deploy and pay off that money, that is my opportunity cost, is I lose the ability for my money to continue to work for me. However, if I leverage against my policy, just as I would leverage my policy for any other singular cost, I'm going to pay interest on that, and I'm going to amortize that cost over time if I decide to pay off the loan. Now, I may not choose to pay off the loan, and I may just pay it out of my death benefit in the future. So I have to, am I going to pay interest on that or not interest on that? Am I going to pay the principal on that loan or not? This is where the infinite banking practitioner comes into its value, is saying, analyzing the loan and saying, is it worth me paying it off? However, you may decide that I've got that $1 million in my life insurance contract earmarked for something different, and I'm really struggling with paying this tax bill off with that. Talk to your infinite banking practitioner. Like, do you have another facility to pay off that capital gains tax? Maybe, maybe not.
Hmm. Yeah, makes sense. I guess it's such a yeah. There's it all depends. Like it's such a nuanced, scenario.
Absolutely.
Yeah, makes sense. Um, Mike, this was such a great conversation. If someone wanted to learn more, reach out to you. Where's the best place they can find you?
Yeah, generally speaking, Costa, the collaborative group, the Infinite Banking Canada group, is best to check out at ibcanadagroup.com. And they can access resources, talk to an infinite banking practitioner in their local province, have a conversation with them, sign up for the masterclass. All of our contact info is there on the about us part of the website, and there's just a ton of information there about infinite banking and links to our YouTube channel, and we've got a lot of videos on YouTube about infinite banking in Canada. So just I would just suggest that that site is the kind of the first place that I would go to is ibcanadagroup.com.
Perfect. And is someone like let's say from Ontario able to work with a practitioner in another province, or do you have to work with someone in the same province?
Are you going to hate me for saying it depends again?
Oh, come on.
Yeah, it's in Canada, which is not necessarily true in the States, but in Canada, we are all provincially regulated, and the
Okay.
the representative insurance councils of each province license insurance agents in each province. So if somebody, we've got many practitioners that are multi-provincially licensed. So just
Mm,
because you have somebody living in, I don't know why I'm thinking of the name, but Flin Flon, Manitoba, and they want to deal with Steve McClellan, who's in Halifax. If Steve is licensed to deal in Flin Flon, then or in sorry in Manitoba, then he could deal with them.
yeah.
My preference would probably be that if you're in Manitoba, you should talk to Tom Rennick, who's our a licensed guy in Manitoba. But there's many people that are multi provincially licensed. So again, contact ibcanadagroup.com through that website, and we'll find a practitioner. If you're asking for a specific practitioner, it'll depend on whether they're licensed in your province to do business. So,
Nice. Okay. Perfect. Perfect. Good to know. Michael, it was a real pleasure. Thank you so much. I'm excited to share this and just get more people aware of all this amazing information, and hopefully it piques some interest and builds up the momentum in with this concept for sure.
well, thanks very much, Costa, for your time and allowing me to just speak to your listeners. And I would just encourage people to remember that using an authorized practitioner
Yeah.
is the most important first step in your journey of discovering what IBC is, how it works in Canada, what the differences are in the rules, regulations, laws, and legislation surrounding insurance contracts in Canada compared to the US. And yeah, for more information, feel free to reach out. But thank you for having us on.
Amazing. Thanks again, and we'll be in touch.
Okay, thanks, Costa. Appreciate
All
it.
right.